balance sheet, a beginning balance sheet, and a statement of cash flows, and we have to work backwards to prepare the ending balance sheet for the year. So the following beginning balance sheet and statement of cash flows for 2019 are available for FASI company. Then we have our balance sheet and our statement of cash flows. And then over here on the right, on the basis of this information, prepare a balance sheet for FASI as of December 31st, 2019. And so they kind of gave us the format here: assets, total assets, and then our liabilities and equity. And so I'm just going to pull over these accounts here. And then we can look at this information and the statement of cash flows to figure out what our ending balances are. So we have starting with cash, and we know that our ending balance sheet cash has to be this December 31st cash amount of $1,500. So I will just cell reference that $1,500. Then accounts receivable, we had a beginning balance of $2,300, and we can see here that there was an increase in accounts receivable for $700. So our $2,300 plus that $700 gives us $3,000. Land was $4,900, and if we look down in this information, we see we sold land for $1,200. And there's a gain on the sale of $2,000. And so that means, $200. So that means that we're going to have a $100 adjustment to land, because that $200 gain on the sale wouldn't actually impact the land itself, only the part of the transaction that shows us getting rid of that land. And so we can say this $4,900 minus, and then just for the sake of using Excel, we'll say the proceeds minus the gain. And so that should give us $1,000 difference. And so we have land balance of $3,900. For equipment, we had a beginning balance of $20,000. And if we come down to our investing activities, we see that we purchased another $5,000. So we'll have $20,000 plus that $5,000 to give us equipment of $25,000. Then for our accumulated depreciation, we had $9,100, and we had an additional $900. So we should have a balance of $10,000. And so if we do a sum here, we get total assets of $23,400. Now we're just going to do the same thing for the other side of this. So we have accounts payable of $1,600 and an increase in accounts payable of $100. So obviously that's now $1,700. We'll add those together. Notes payable was $3,900, and we see here there is a payment of a long-term note for $900. So we have subtracted that $900, which gives us a balance. I accidentally said equals of $3,000. Common stock $5 par was $4,500. And in our financing activities, we have proceeds from the issuance of common stock, 200 shares, $2,600. So down here on the side, let's just calculate our 200 shares times $5 par. One too many zeros. Gives us an increase of 1,000 for common stock. So we'll say equals 4,500 plus that 1,000. I'll just put a note here that this is common stock par, but we issued it for $2,600, So 2,600 minus that 1,000 gives us 1,600 in additional paid-in capital, or APIC. And that's what's next. So for our additional paid-in capital, it was previously 1,800, and we know we've now increased that by 1,600. So we have 3,400. And then retained earnings was 7,200. And if you remember from a basic accounting class, retained earnings is equal to our net income minus dividends, or revenues minus expenses minus dividends. And so we have this information because we started with net income of 3,900, and we have dividends of 1,300. So retained earnings should have increased by 2,600. And so we'll take our previous 72 plus the 26 for 9,800, and then do a sum. And we see that our assets balance with our liabilities and equity. Had they not balanced, we would need to comb back through this and see if we might have missed a piece of information somewhere. Like, for example, maybe on the common stock you forgot about the additional paid-in capital or something like that, or maybe you forgot to deal with dividends in your retained earnings or something that would cause your balances to not balance one another.